1 billion ounces. That's how much silver JPMorgan has reportedly accumulated since 2011. 1 billion. To put that in perspective, that's approximately 20% of the entire world's investable silver supply, gone, sitting in vaults controlled by America's largest bank. And here's what should terrify you. They're not selling. Even at $58 per ounce, even at all-time highs, they're still buying. December 2025, while retail investors panic sell, while traders chase quick profits, JPMorgan quietly moved another 13.4 million ounces into their vaults. Why would the bank that literally helps set global silver prices be hoarding the metal like their survival depends on it? By the end of this video, I'm going to show you the 4-stage pattern that explains exactly what JPMorgan knows that you don't, and why their silence is louder than any announcement they could make. Let me show you something that's happened 3 times in modern financial history. 3 times when major institutions positioned themselves before a massive wealth transfer. And 3 times, the people who followed the smart money made generational returns. There's a pattern, a 4-stage mechanism that plays out every single time a commodity market breaks. And JPMorgan, they're not just watching this pattern, they're orchestrating it. Stage 1, suppression. A bank takes massive short positions. They flood the market with paper contracts. Prices stay artificially low for years, sometimes decades. Everyone believes the commodity is worthless. Everyone except the bank. Stage 2, accumulation. Quietly, the bank starts flipping their position. They cover shorts. They start buying physical, not paper promises, actual metal. They do this slowly, carefully, so nobody notices. This stage can last 5, 10, even 15 years. Stage 3, the drain. Inventories start disappearing. Other institutions notice. Industrial users panic. Retail investors finally wake up. Prices begin rising. But the bank already owns the supply. They control the game. Stage 4, the explosion. The paper market breaks. Physical supply vanishes. Prices don't rise, they detonate. The bank that spent a decade accumulating, they win. Everyone else learns an expensive lesson about being late to the party. Right now, today, we are deep into stage 3. And I'm going to prove it using JPMorgan's own actions. But first, you need to understand why JPMorgan is playing this so differently than everyone who tried before them. Nelson and William Hunt, 2 Texas oil billionaires, start buying silver. They accumulate 200 million ounces, half physical, half futures contracts. Their thesis? The dollar is dying. Inflation is destroying purchasing power. Silver is real money. They weren't wrong. Silver goes from $6 in January 1979 to $49.45 by January 1980. That's 724% in 12 months. The Hunt brothers are worth billions. They're the richest men in America. And then COMEX changes the rules. January 7th, 1980. Silver Rule 7. No more long positions allowed. You can only sell. They froze the Hunts out completely. Margin requirements get raised overnight. The Hunts need hundreds of millions they don't have. March 27th, 1980. Silver Thursday. The price collapses from $21 to $10.80 in a single day. The Hunt brothers lose $1.7 billion. They declare bankruptcy. The system almost breaks. But here's what everyone forgets. The people holding physical silver, actual metal in their possession, they didn't lose anything. When the dust settled, silver was still 66% higher than where it started. The Hunts failed because they used leverage. They used futures. They fought the system from the outside. JPMorgan learned from that mistake. They're not fighting the system. They are the system. Bear Stearns collapses. JPMorgan acquires them in a fire sale orchestrated by the Federal Reserve. And with Bear Stearns, they inherit something toxic. Massive short positions in silver. For years, market observers accused JPMorgan of manipulating silver prices downward, flooding the market with paper contracts, suppressing prices. In 2010, they reportedly settled manipulation charges for around $200 million. But something changed after that settlement. According to COMEX vault data, starting in April 2011, JPMorgan begins accumulating physical silver, not paper, physical metal, and they never stopped. 2011, 50 million ounces added to their vaults. 2013, 75 million more. 2015, 100 million. 2017, 150 million. By 2020, industry analysts estimated JPMorgan held approximately 675 million ounces in their house account. That's more than the Hunt brothers ever controlled, more than Berkshire Hathaway, more than entire nations. And in 2025, reports suggest they're sitting on close to 1 billion ounces. Let me put that in context. Global annual silver mine production, approximately 813 million ounces. JPMorgan reportedly controls more silver than the entire world mines in a year. That's not investing, that's cornering the market. Now, watch what JPMorgan is doing while everyone else panics. November 28, 2025. COMEX experiences what they call a cooling system failure. The exchange goes down for over 10 hours. During that outage, silver spikes to $56.72, an all-time high at that moment. And JPMorgan? According to COMEX filings, they reclassified 13.4 million ounces from registered to eligible status. Let me explain why this matters. Registered silver is available for delivery against futures contracts. Eligible silver is just stored there. It's off the table. It's not available. Think about the timing. The exchange goes down during peak physical demand, and JPMorgan pulls 13.4 million ounces off the delivery table. That's 9% of all deliverable silver at COMEX. Then, December 6th, 2025, silver hits $59.32, all-time high. Retail investors are celebrating, traders are taking profits. JPMorgan? Reports indicate they moved approximately 169 million ounces into their vaults. While everyone else is selling, they're buying. This is not the behavior of a bank that thinks silver has peaked. This is the behavior of a bank that knows something you don't. So what does JPMorgan see that the rest of the market doesn't? First, the supply crisis is real. Global silver deficits for 5 consecutive years, approximately 820 million ounces of cumulative shortage. Mine production declining. Above-ground inventories draining. Second, industrial demand is exploding. Solar panels alone consumed 680 million ounces in 2024. Electric vehicles, 5G infrastructure, AI data centers, every trend defining the modern economy requires silver, and there are no substitutes at scale. Third, the paper market is breaking. COMEX has approximately 244% open interest versus vaulted silver. That means there are 2.44 paper claims for every ounce of physical metal. When contract holders start demanding delivery, the system faces serious stress. Fourth, governments are waking up. The U.S. just declared silver a critical mineral. Section 232 tariff investigations are underway. Estimates range from 15% to 50% import duties. And America imports 64% of the silver it consumes. When those tariffs hit, imported silver becomes 50% more expensive overnight. Industrial users will panic buy. Prices will spike. And JPMorgan will be sitting on 1 billion ounces that just became exponentially more valuable. Here's what I think JPMorgan is preparing for. They've watched the pattern 3 times. They know how this ends. The paper market will break. It has to. The math doesn't work. You cannot have 244% leverage on a finite physical commodity without something eventually snapping. When that break happens, when futures traders demand delivery and COMEX can't provide metal, contracts will be cash settled. Trust in paper, silver will evaporate. Physical premiums will explode. And JPMorgan, sitting on 1 billion ounces of physical metal, will name their price. Think about it. If silver hits $100 per ounce, JPMorgan's position is worth $100 billion. At $150, that's $150 billion. At $200, $200 billion profit. But here's what's even more important. They're not accumulating to sell at $100. Banks don't spend 14 years building a position just to take a quick profit. They're accumulating because silver is going to play a role in the next monetary system. When central bank digital currencies roll out, when the dollar's reserve status faces real challenges, when the global financial system needs to be reset, silver and gold will be part of that foundation. They always have been throughout history. JPMorgan isn't betting on a bull market, they're positioning for a monetary reset. So here's the critical question. If the largest bank in America is hoarding silver like their future depends on it, what does that tell you? It tells you the shortage is real, the demand is real, the coming price explosion is real. You have a choice right now. You can ignore what JPMorgan is doing and hope you're smarter than the bank that literally helps set global silver prices, or you can follow the smart money while there's still time. Physical silver is available today. Premiums are rising, but it's still accessible. When stage 4 hits, when the paper market breaks, availability won't matter. Because at any price, you won't be able to find it. JPMorgan spent 14 years accumulating 1 billion ounces. They did it quietly, patiently, methodically. They're not selling at $59. They're not selling at $60. And they're definitely not selling at $75 or $100. They know where this is going. The only question is, will you be positioned before everyone else figures it out? If this connected the dots for you, if you see what JPMorgan sees, subscribe right now.